Warren Buffett is a well-known investor and has taught us many valuable lessons on how to invest like him. In this video, we'll go through his 9 investing tips on how to invest in 2023, the Warren Buffett way. Before we dive into these tips, let's first take a look at what happened in 2022. Many investors had to learn the hard way that stocks do not continuously go up. Warren Buffett has taught us that interest rates are the central force that makes stocks go up and down. Interest rates are to asset prices while gravity is to the apple. When interest rates are low, there is a low gravitational pull on asset prices, and when interest rates are high, there is a high gravitational pull on asset prices. Jerome Powell, who is at the helm of the Federal Reserve, has been increasing rates, which has brought stock prices down. Powell plans to keep raising rates in 2023, which may keep bringing stock prices down, and we need to be prepared for this. Tip number 1: be a value investor. Warren Buffett's first investing tip is to be a value investor. Being a value investor means looking for companies that are currently undervalued by the market and purchasing them at a discount. In other words, a value investor wants to buy a company for less than what it's worth. This is different from other investing strategies that focus on growth and momentum. Growth investors are looking for companies that are growing quickly and have the potential for future growth, while momentum investors are looking for stocks that are moving in a particular direction, either up or down. Value investors, on the other hand, focus on finding companies that have strong fundamentals and are trading at a discount to their intrinsic value. They look at metrics like price-to-earnings ratio, price-to-book ratio, and dividend yield to determine if a company is undervalued. One of the key principles of value investing is to have patience. A value investor is willing to wait for the market to recognize the true value of a company and for the stock price to rise accordingly. They are not concerned with short-term fluctuations in the stock price, but instead focus on the long-term prospects of the company. Another important aspect of value investing is to do your own research and analysis. Warren Buffett is known for spending hours reading annual reports and financial statements to understand the company's business model, competitive advantage, and management team. Value investors do not rely on tips or recommendations from others but instead trust their own analysis and judgment. Being a value investor means having a contrarian mindset and being willing to go against the crowd. It means having the patience to wait for the right opportunities and the discipline to stick to your investment strategy even during times of market volatility. Tip number 2: be greedy when others are fearful. Warren Buffett's tip number 2, be greedy when others are fearful, is all about taking advantage of the market when it's in a downturn. When other investors are scared and selling their stocks, Buffett sees this as an opportunity to buy great companies at a discounted price. The key here is to have a long-term perspective and not be swayed by short-term market fluctuations. When the market is down, many investors may panic and sell their stocks out of fear of losing money. But as a value investor, Buffett sees this as a chance to buy high-quality companies at a cheaper price than they were trading at before. Buffett's investment philosophy is rooted in buying and holding on to stocks for the long term, which means he is not concerned with short-term market volatility. He believes that over time, the market will recover, and the companies he has invested in will continue to grow and generate profits. Tip number 2 is about having the courage to go against the herd mentality and make your own decisions based on your analysis of the market and the companies you're interested in. Buffett's approach is to do his homework, understand the companies he is investing in, and then take advantage of market downturns to buy those companies at a discount. By being patient and disciplined, he has been able to create tremendous wealth for himself and his investors over the years. Tip number 3, don't predict the market. Warren Buffett's third investing tip is to not try to predict the market. Buffett believes that trying to predict the market's short-term movements is a fool's errand and ultimately leads to poor investment decisions. He argues that instead of focusing on predicting the market, investors should focus on investing in American businesses that they believe will perform well over the long term. Buffett's belief in the long-term success of American businesses is grounded in historical data. He notes that over the course of the 20th century, despite numerous challenges such as 2 world wars, a Great Depression, and flu epidemics, American businesses still did well over time. In fact, during this period, stocks on the Dow Jones Industrial Average went from 66 to 11,497, and investors were earning 3 times as much in dividends as the whole average was selling for at the start. Buffett's approach is a reminder to investors that investing should be focused on the long term and that trying to time the market or predict short-term movements can lead to missed opportunities and suboptimal returns. Instead, he encourages investors to focus on investing in quality companies that have a proven track record of success and are likely to continue to perform well over the long term. Tip number 4, invest in what you understand. Warren Buffett's tip number 4 emphasizes the importance of investing in what you understand. When investing, it's essential to know what you're investing in, including the company's business model, financial statements, and future prospects. This requires a thorough understanding of the industry, market trends, and the company's competitive advantage. Buffett believes that investing in companies you don't understand can lead to significant financial losses. He often advises investors to avoid complex financial instruments and stick to investments that they can understand easily. Buffett's investment strategy relies heavily on the quality of the business itself and its potential for long-term growth. For example, when investing in Chevron and Occidental Petroleum, Buffett understood that they were low-cost oil producers with sustainable business models that would provide consistent profits over the long term. Similarly, when investing in Taiwan Semiconductor, he recognized its essential role in the technology industry and its ability to produce high-quality components that would be in demand for many years to come. Investing in companies that you understand also allows for better decision-making when it comes to buying and selling stocks. If you don't understand a company's business model or the factors that affect its stock price, it can be challenging to know when to buy or sell the stock. By investing in what you understand, you can make better informed decisions and have more confidence in your investments. Tip number 5, stay patient. Warren Buffett is famous for his patient approach to investing. He believes that patience is a key ingredient in successful investing. One of the reasons why he likes to hold on to stocks for a long time is that it allows him to avoid transaction costs and taxes, which can eat into investment returns. Buffett's philosophy is that when you invest in a good company, it's important to give it time to grow and realize its potential. This is why he is known for saying, "Our favorite holding period is forever." He believes that buying and holding stocks for a long time is the best way to capture the full value of a business. One of the benefits of staying patient is that it allows you to ignore short-term fluctuations in the stock market. Buffett believes that the stock market is driven by emotions in the short run, but over the long run, it is driven by the underlying fundamentals of the business. This means that if you have patience, you can ride out the short-term volatility and focus on the long-term growth potential of the companies you invest in. Staying patient also allows you to avoid the temptation to buy and sell stocks based on market trends or the latest news headlines. Buffett believes that this kind of short-term thinking is a recipe for failure in investing. Instead, he recommends that investors focus on the long-term prospects of the companies they invest in and have the patience to let their investments grow over time. Warren Buffett's tip number 5 is to stay patient when investing. He believes that buying and holding stocks for a long time is the best way to capture the full value of a business and that having patience allows you to avoid short-term fluctuations in the stock market and focus on the long-term growth potential of the companies you invest in. Tip number 6, don't follow the crowd. Warren Buffett has emphasized the importance of independent thinking when it comes to investing. He warns against following the crowd, as the market is often driven by emotions and can be irrational in the short term. Buffett believes that investors should focus on the fundamentals of a company and its long-term prospects, rather than the current market trends or popular opinions. Following the crowd can also lead to herd behavior, which can cause a bubble or a crash in the market. Investors who follow the crowd may end up buying stocks that are overpriced or selling stocks that are undervalued, just because everyone else is doing it. This can lead to missed opportunities and losses in the long term. Instead, Buffett advises investors to do their own research, analyze the financial statements of a company, and understand the business model and competitive advantages of the company. This allows investors to make informed decisions based on their own analysis and judgment, rather than relying on the opinions of others. Buffett's advice to not follow the crowd is a reminder to investors to remain independent, thoughtful, and patient when making investment decisions. By sticking to one's own investment strategy and avoiding the herd mentality, investors can increase their chances of success in the long term. Tip number 7, invest in high-quality companies. Buffett is a firm believer in investing in high-quality companies that have a strong competitive advantage, also known as a moat. The concept of a moat refers to a company's ability to maintain its market position over time, even in the face of competition. Buffett believes that companies with a durable competitive advantage are able to generate strong cash flows and profits, which can lead to long-term value creation for shareholders. When evaluating companies, Buffett looks for those that have a sustainable competitive advantage, whether it be a strong brand, patents, proprietary technology, or a unique business model. He looks for companies that are able to maintain high profitability over time and generate consistent cash flows. Buffett has often cited his investment in Coca-Cola as an example of investing in a high-quality company with a strong moat. Coca-Cola has a strong brand and a loyal customer base, which has allowed it to maintain its market position for over a century. The company's ability to generate consistent cash flows has led to strong returns for shareholders over time. Investing in high-quality companies can provide investors with a sense of security in their investments, as these companies are often less susceptible to economic downturns and are better able to weather market fluctuations. However, it's important for investors to carefully evaluate a company's financials and competitive position before making any investment decisions. Tip number 8: understand the management team. Warren Buffett considers the management team as a crucial factor to consider when investing in a company. He looks for companies with a talented, experienced, and trustworthy management team that is committed to creating value for shareholders. He believes that a good management team can make a significant difference in the long-term success of a company. Buffett looks for companies whose management team is transparent, honest, and has a track record of making wise decisions. He wants to see that the company's management is making decisions that benefit the company as a whole, not just their personal interests. Buffett also looks for companies with a management team that has a significant stake in the company, which shows that they have skin in the game and are incentivized to create value for shareholders. One of the things that Buffett emphasizes is the importance of a shareholder-oriented management team. This means that the management team prioritizes the interests of shareholders over their personal interests. They are committed to creating value for shareholders by making sound business decisions, investing in the growth of the company, and returning profits to shareholders through dividends or share buybacks. When investing in a company, Buffett pays close attention to the management team and looks for companies whose management has a proven track record of making sound business decisions, prioritizing the interests of shareholders, and creating long-term value. Tip number 9: have a margin of safety. To put it simply, the margin of safety is the difference between the market price of a stock and its intrinsic value. Buffett believes that buying a stock at a significant discount to its intrinsic value reduces the risk of capital loss and enhances the potential for capital gain. Intrinsic value is the true worth of a company based on its assets, earnings potential, and other factors. It's important to note that intrinsic value is subjective and can vary based on an investor's assessment. Buffett calculates intrinsic value using a discounted cash flow model, which estimates the future cash flows a business will generate and discounts them to their present value. By purchasing a stock at a discount to its intrinsic value, an investor has a cushion of safety in case the stock price falls due to unforeseen events or unfavorable market conditions. This means that even if the market price of the stock drops, the investor has a built-in buffer that can help reduce losses. Furthermore, by buying stocks at a discount, investors increase their potential returns as the stock price moves closer to its intrinsic value over time. Having a margin of safety is a fundamental principle in value investing and a key reason why Buffett has been successful. By buying high-quality companies at a discount to their intrinsic value, he has been able to minimize downside risk and maximize potential upside returns over the long term. In summary, Warren Buffett's investing tips for 2023 include being a value investor, being greedy when others are fearful, not predicting the market, investing in what you understand, staying patient, not following the crowd, investing in high-quality companies, understanding the management team, and having a margin of safety. By following these principles, investors can potentially achieve success in the stock market over the long term. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.